A business can be profitable on paper and still run out of cash. The mechanism that explains how that happens and how to fix it is the cash conversion cycle. In this episode, we build the CCC from first principles, run through a full numerical example, and cover the real-world interpretation points that matter most to CAs in practice. Working capital in its raw form is simply current assets minus current liabilities. But for operational analysis, we strip it down to the three drivers that management can actually influence: inventory, trade receivables, and trade payables. Liquid assets like cash and short-term borrowings are excluded from the operating cycle. They are the result of how well the cycle is managed, not inputs to it. The cash conversion cycle measures how many days of cash are locked inside the operating cycle. You pay suppliers, you hold and sell inventory, you collect from customers. The CCC is the net number of days between the cash outflow and the cash inflow. A company with a CCC of 60 days needs to finance 60 days of operations from its own resources or borrowings. Reduce that by 10 days and you have effectively freed up the equivalent of 10 days of cost of sales in cash. Let us define each component precisely. Days inventory. Outstanding is the average number of days inventory sits on the shelf before it is sold, calculated as average inventory divided by cost of sales, multiplied by the number of days in the period. Days sales outstanding is the average collection period for receivables. Average trade receivables divided by revenue times days. Days payable. Outstanding is how long the business takes to pay its suppliers. Average trade payables divided by cost of sales times days. Note the denominator. DIO and DPO use cost of sales because both inventory and payables relate to purchases. DSO uses revenue because receivables arise from sales at selling price. Here is the flow of cash through the operating cycle. Cash leaves when we pay suppliers. It is then embedded in inventory, converts to a receivable when we invoice the customer, and finally returns as cash when the customer pays. The cash conversion cycle is the elapsed time across this entire loop, net of the free credit we receive from suppliers via DPO. Let us work through a realistic example. Retailer X has annual revenue of 480 million, cost of sales of 320 million, average inventory of 80 million, average trade receivables of 40 million, and average trade payables of 53.3 million. Days in period, 365. Plugging into the formulas, DIO is 80 million divided by 320 million times 365. That gives us 91.3 days. DSO is 40 million divided by 480 million times 365, 30.4 days. DPO is 53.3 million divided by 320 million times 365, 60.8 days. The cash conversion cycle is 91.3 plus 30.4 minus 60.8, 60 days. Retailer X needs to finance 60 days of operations at any point in time. Visualizing the three components in isolation shows where the pressure points are. For Retailer X, inventory is by far the dominant driver. 91 days of stock holding is significant for a retailer and warrants interrogation. Is it seasonality, slow-moving lines, or a deliberate buffer against supply chain risk? The DPO of 61 days provides meaningful relief, but if suppliers start tightening terms, the CCC could worsen materially without any operational change at all. Now for the interpretation nuances that separate a CA from a spreadsheet. First, industry context is everything. Amazon's retail business famously runs a negative CCC. It collects cash from customers before it pays suppliers, meaning the business is supplier financed. Contrast that with a construction firm or an aircraft manufacturer, where CCCs of 300 days or more are structurally normal. Cross-industry comparisons are almost meaningless without adjustment. Second, watch for window dressing. A year-end receivables collection push compresses DSO on the snapshot date, but does not represent the annual average. Always ask whether average balances or point-in-time balances were used. Management has 3 levers: to reduce DIO, improve demand forecasting, adopt just-in-time procurement, or rationalize the SKU count. To reduce DSO, tighten credit terms, offer early payment discounts, or deploy invoice financing. To extend DPO, negotiate longer supplier terms, or use supply chain finance programs. But be careful here. Stretching payables beyond agreed terms destroys supplier relationships and may signal liquidity stress to an astute creditor or auditor. IAS 7 requires disclosure of significant non-cash financing arrangements, and supply chain finance programs have attracted scrutiny from the IASB precisely because they can obscure true payables days. From a going concern and audit perspective, a deteriorating CCC is one of the earliest quantitative signals of financial distress. If DIO is rising while revenue is flat, inventory is becoming harder to sell. If DSO is rising, customers are struggling to pay, or the business is granting looser credit to prop up revenue. If DPO is spiking, the entity may be unable to pay suppliers on time. ISA 570 requires auditors to evaluate whether there are indicators of going concern doubt. The CCC trend is exactly the kind of operational indicator that should be on every going concern checklist. Finally, working capital and the CCC feed directly into free cash flow modeling. An increase in net working capital is a cash outflow in the cash flow statement, consistent with IAS 7's indirect method reconciliation. When you are building a DCF or advising on a leveraged buyout, the CCC tells you how much working capital investment scales with revenue growth. A business growing at 20% with a 60-day CCC needs to fund 20% more working capital each year just to sustain that growth. That is real cash that never shows up in the EBITDA line. To pull it all together, the cash conversion cycle is the operational heartbeat of any trading business. Know the formulas cold, use averages, not snapshots, always benchmark within industry, and treat a worsening trend as a red flag, whether you are in audit, advisory, or a finance leadership role. The best working capital managers do not just measure the CCC. They actively manage each of the 3 subcycles as a strategic priority.